Guys, we're starting, and welcome for coming to our event. And this event is hosted by YANIS Russian-speaking community at Yale. A couple of hundreds of people from different schools, including the School of Management. And if you would like to get this flavor of how Russian-speaking guys think, what songs they sing, and what they're doing in life, just join us. So on the other side, PVC Fund and Yale Club helped us to organize that. Just join them. And today we have Liberman brothers, Daniil and David, and the Prof. Jason to moderate this discussion. So I have only one ask for you. Just make it as provocative as possible. Ask hard questions and no sugar cutting for today. So listen, please.
Wow. I think we might just start off. I mean, you have an interesting story and interesting stories. Maybe just tell us a little bit about your background and how you came to this investing in people.
My microphone is recording, but I'm not sure if it's... Okay, let's just speak louder. Story. Born in Soviet Russia 42 years ago, 41 years ago. We are kids of the Russian quantum biophysicists. Both of our parents were top-notch scientists researching how neurons works, how they wanted to discover how consciousness works. And our dad was born in 1925, so he started early and stopped making kids late. But growing up in this environment, we were supposed to go to science, but then the Soviet Union collapsed and it never happened. So we just needed to feed the family of elderly parents and 6 more brothers and sisters going to school. There are 9 of us kids, brothers and sisters. It's a really interesting dynamics. The 5 of us work together as a team building businesses since the beginning of 2000s. And then this particular idea was sort of around in our mind as a subject which we were frequently discussing among the 2 of us. The economy of talent, sort of. I mean that it's much wider than just this. And when we moved to the States, this became more obvious that the environment changes perspective on the investment. We built our first businesses back in Russia, and it was completely different experience of us building businesses in the United States. To the extent that we were threatened to be killed by the bandits and shit like this, but over here, it never happened.
No death threats yet?
Not yet. And then when we moved here, we saw how a lot of our peers, same age peers, were sort of struggling in being not able to raise capital in some cases, and we were like, how is it possible? The environment is the easiest to ever experience in our life in terms of being able to raise capital for the business ideas. And only then we realized that it's less about the environment and more about the debt, which is on the shoulders of the students and other cultural or historical aspects of this. And when we finished the first and only employment in our life, this was Snap. Snapchat acquired our company back in 2016, and never before that we worked for anyone. Never after that we still have not worked for anyone. And this 4 years was quite an experience. But as soon as we finished it, we knew that we want to do everything forward in a quite different manner than it's been done by us before. Not raising money for the particular new company, but raising money for our entire vision of what we want to change in the world and what we will do, and basically raising money in us. And there was a line of investors who wanted to invest in our next company, and we said no to almost all of them, and said, like, you should invest in us as individuals in the next 30 years of what we're going to be building. And they said, okay, show us a list of what it's going to be. And there's no list. You just invest in us and believe that we will build something. It sort of worked to the extent that the bravest of them actually did that. And with the money, we started the first company after Snap, which was a software engineering tool, AI software to increase efficiency of other software. Basically, rewrite the code and show inefficiencies in the applications. And this experience actually was about to show that should we have raised money in a conventional way, we would have give up more of the share, rather than in the case when we actually raised money for the next 30 years, and then we own higher stake of the next company, which we sort of pivoted with the money, which was money provided for the rest of the life of the 30 years. This sort of experience gave us a clue of what we then called humanism, and we raised more money and invested in 13 people, more than that, 13 people, with the same idea, with the same in the same model of investing for the next 30 years of an individual rather than a particular company. This experience is still happening. So it's not that the story has the ending, but we will be happy to give more juice and details of how it's really going so far.
I would like more details because this is pretty fascinating to me. So your idea investing in people, so you just writing a check and handing it to someone, and that's that. And tell me about the mechanics of that. How does that work? How do you realize returns on this investment?
Previously we invested in 60 more startups, and the process is almost the same. Yes, 60. Yes,
60.
And the process is almost the same. You first want to invest in individual and in the vision of this individual, and in a kind of passion for the success in some venture. Especially when you invest in early stage, there are no much signals that this particular idea will work. So your whole evaluation process is about this human being. So from that perspective, investing in individual is the same.
The only additional question which you try to answer is whether the individual stop or not stop creating companies after failures, multiple failures, because failures will cut. In the sad statistics of the market in which we work, which is a tech venture, is that 80% of the companies which raised money from the venture firms will fail, completely losing all of the money.
And you heard all the stories about immediate success. Someone dropped out from the college and created $1 trillion company. It's quite a rare thing. Most of the success doesn't really look like that. Most of the success is a series of failures after which you are successful. And if you look at the statistics, it's kind of obvious that if you invest in individual who will continue even after failure, your chance for success is almost 100%. So from this perspective, we kind of, that's additional kind of criteria, as Daniil mentioned, is whether we see this passion in this individual to create something independently, so they will not just stop and switch to a regular job. When they fail, they will just start in new venture after that?
The regular VC would ask a question, whether you are completely focused in this particular whatever, and if you're like disfocused on running several startups, they will be like, no, nothing. And then in this case, you sort of expect that they have like the individual have millions of ideas, like even that. Don't need to have millions, like 10 ideas of different, like this can be done today, that can be done today, that can be fixed, that can be fixed. You sort of need to be focused on the particular moment on this particular startup. But the fact that you actually see a lot of stuff which can be done and you're passionate about all of them sort of shows that you, even this one, if this one will fail, you'll still find the next one to continue.
Yeah, well, you say, okay, here's my first pushback, I guess. You say that it's just like any other VC investing, only you're investing in people. But I think that the typical investment is an uncontroversial kind of transaction because you never stop and really think about the tremendous regulatory framework surrounding it. I know all my rights and remedies and everything when I invest in a company, and I know my recourses if I don't, if you don't... With a person, right? Like literally how do you realize your investment?
Specific mechanics is honestly the startup mechanics. So individual apps, we created a company which is called the Libermans, like Liberman's Corporation. And the Liberman's Corporation, or like in the case of like, I don't know, Pavel Corporation or whatever it is, like username corporation is actually a C Corp, which then raises money from the investors in a similar manner. The only difference between the regular startup and this company is that this company works as sort of a venture studio in a way, which individuals sign, in which individual who owns the 100% of the entity at the very beginning when they start the entity, they sign a pledge, a non-compete pledge agreement with themselves, with their own corporation. And this non-compete pledge agreements basically said, whatever I will create in the future, I will do through this corporation. And my outcome, even if, let's say I was hired, or I sold the company, or I created something on the side, all of my future proceed, which exceeds a particular bottom line, let's say like a safety net. In our case, it was $300,000 a year safety net. So like this is a salary which like any company in Silicon Valley we will pay us right away. So like let's say this is like the bottom line, and everything above that's what you expect. You want us to be billionaires, like making $300,000 a year. So the $300,000 a year is sort of untouchable income, and the rest, whatever we make, whether it's selling crypto or creating a new company or being employed as a C-level executive at Apple and making like tens of millions of dollars a year, everything above the $300,000 goes to this corporation.
Okay, so it's not so much a claim on it's not so much a claim on a person or a person's assets or your soul. Well, we'll get there. But it is so it's literally a non-compete that all the ventures I will start through this umbrella, if you will, and then all the proceeds I would have rights over them, just like I would have rights if I was investing in one individual entity, one company.
In general, when you start a company, it's almost the same whether you register the shares for yourself or for equity. The process is almost the same. And actually, a lot of experienced founders, after the first attempts, they, in any case, register their share under the name of a trust or a company in between because of the tax reasons or legal reasons. So from this perspective, nothing actually, legally nothing is different. Nothing changes for those startups and for the ownership of the shares in the startups. You just accumulate this ownership in a holding structure and then invite investors to invest in that.
It's if like Warren Buffett is doing everything in Berkshire Hathaway, and no one
many companies are owned by.
Everyone sort of expects that his brain is in this company.
We had a lot of I guess people submitted questions when they registered. I think one of the most common themes in these questions is about how it is that you find this talent or select the talent into which you're going to invest, or how it finds you, as it were. Can you tell us all about that?
So there are two different processes. One is the process which we employ right now, and another process which we kind of envision we can build for the future. In the future, we want this tool to be accessible to everyone. We want this tool, if you want to do this, the capital should be there for you to immediately start.
Think of like an index or ETF of specific groups of people divided by quantitative or education or other part.
But for this future to become reality, a lot of additional elements of ecosystem should be in place, because you need to have analytics agencies for every different vertical, so the data to predict what kind of probabilities of success for in different type of professions. In our case,
what we're doing right now, have been doing for several years, is we took the data of a specific market, of the VC venture investment in tech companies of the United States, and the data accumulates over 50,000 different companies over the last 20 plus years. And the data accumulated from 3 different sources, plus on top of that, we put the LinkedIn data on every single founder of the 30,000 companies over time. We just basically reverting this data from the ground up, from the company perspective to the founder perspective, and the sequence of companies the founder did, and the sequence of jobs the founder had in between his own companies, her own companies.
And from this perspective, we can quite clearly statistically predict what we can expect from not one individual investment, but from a portfolio of 20 investment like that. We also, there is a fund who works in a different industry. They work in the industry of college athletes. They did the same. They took the entirety of data of success of different college athletes, and based on that model, they create a prediction of what should be the value of one such investment. And then they invested in 70 college athletes.
What's interesting with this particular fund, the value which they gave to all of these college students was the same for all of them, but it was $10 million. So it was right away very high. So it's like our model predicts that if we invest in the 70 individuals whose scores, numbers, they had the model, fit in the model, and we give them from $500,000 to $1 million for 5 to 10% of their future profits in their athletic career. They did this. They invested in 70 people, and eventually, out of the 70, one at the top scored a $350 million contract over 15 years. And then the rest was actually scoring a smaller contract, and some of them never actually went to athletic.
And
the return of the fund was pretty good.
And this is the major difference. Everyone in this room is a millionaire. Like each of
statistically, average. The average expected salary.
Yeah, but some more millionaire than others.
Yeah. Some of them like 10 million.
I teach.
20 million.
Millionaires, from the point of view that if you make $100,000 a year over the course of 30, 40 years of young work years, you make at least $2 million.
And from this perspective, you all are millionaires, but you don't behave this. And what we, our vision, what will change, that the whole definition of wealth can change through that moment.
What's important to understand about the VC, the early stage startup works for some reason several $1 million, even though in the future the same company worth $1 trillion. Like, what's happening in between? So in the beginning, each of you is a startup at the earliest stage or pre-seed startup with an expected income of like Yale graduates making $100,000 a year. This is an expected predicted value already. And then, like, if you have this from the perspective of the fund investing in athletes, they had modeled numbers to say, okay, it's not even $4 million if you just basically say the $100,000, but it's probably more than that. Like, each of you can be raising money at like $5 to $10 million right now, and raising $500,000 to $1 million to $5 million your next company, your first company.
Because returning a little bit to your question, the good part about each of you is that no one can predict who will be this $1 billion individual. No one can predict. It's like everyone can claim, everyone who claims that they can, they lie. No one can predict. But this is a good thing for you, because from that perspective, each of you have this probability of that success, and that increases your value today. And so when we select, first we always remember that we cannot be sure. Like, no one can be sure, but we look for some different signals, like Daniel mentioned. Like, we look psychologically how people think about failures, because failures will be there, and we need to find those individuals who will continue. And this is not always easy to define. It's not as clear of a formula, but there are a lot of traces in terms of previous behavior, how people think about themselves. If you're a student and you now think about what kind of work I want to do, it's probably you asking yourself your own question. If you think about yourself, like, what kind of thing, change in the world I can make, even if it's like tiny probability that you can be successful with that. But if you think about yourself from this perspective, your projected value
increases at this point.
It increases much. And that's type of kind of clues we're trying to find.
We should also understand that we would have to deal with this individual for the next 30 years, and just like, whether it's going to be nice or not.
Fair. I mean, I can't help but share a skepticism. You know, what you're describing, I mean, if I'm my academic, where I can't help but doing, putting this in a familiar framework, you're kind of shifting risk from the individual to a larger entity that can accept more risk, right? And because we don't know who will be the billion, but you're giving everyone some. And in a way, this is like insurance. Yep. And there's two problems, well-known problems with insurance. One is moral hazard, and the other is adverse selection. So on the second one, I mean, I know there used to be these programs that would pay graduate students. So this is trying to scale things up, and for a claim on their future earnings. And a lot of the programs ended up doing poorly because the people who accepted this were less likely to be. The people who were most likely to make the most money were the least likely to accept upfront things for a percentage of what they made, right? And maybe other people, when they get this injection of cash at a young age, maybe this will change their trajectory. That's the moral hazard problem. Because like, this isn't so bad.
VC market already partially solved that problem. So we see a lot of startups, and we saw a lot of data in terms of behavior of these founders of those startups. And from this perspective, one thing you never buy a big share right away. You start small, and then you see how people will use this capital, and based on that, you will invest more. So previously, a normal investment was like all in, and I'm buying 50% of the share of the company. Now, everyone knows that it's really a bad idea, in both from perspective of adverse selection and from the perspective of this company to be actually able to raise more capital. It's really a bad idea. Now, the norm is that first VC firms will invest and buy like 10% on the company, or like even 5% in the company, and then grow from there. So from this perspective, you have a lot of tools to make it more predictable and to kind of balance this process so that it would work in an opposite way, so it will filter those people who just want to
Everybody right now.
and from this perspective, there are tools out there. Also, you look at the current already trajectory of this individual. For sure, to start even earlier when you don't have any data, there will be more challenges there. But when we approach different founders, they already have some signals, and we can see how they actually behave with their startup, or how they behave with the capital which they raised before, or things like that. And from that perspective, you kind of can filter a lot of that, but then still there is a probability of a bad investment. The same with startups, you just include this probability. So for example, one thing which we did, we took the not only like PitchBook data, but also LinkedIn data to answer one question. How often those individuals are expected to go to sabbatical, like to burn out or things like that? And we made the calculation, and it appears that 1 out of 10 years,
For almost every disappeared. Like, knows of what the individual was doing over this year once in 10 years.
so we just added to the model. So add this 10% discount on the cash flow projections, and that's it.
So at the same time, you feel like it's not that you are just giving up cash. There's like a box of cash. People come and you're like, take it, take it, take it. You are an investor, and you risk yourself. You risk with your own money or someone else's money, but it's like that's your risk. So you select. You understand who you with. You will make mistakes, and the mistakes are impossible to predict in some cases. In some cases, the individual going to be in a situation when they cannot just accept their failure, and it might lead to insanity or to cheatiness. Like in both cases, like how could you have predicted this? They're brilliant, they're genius, they're like whenever they're hardworking, and yet psychologically the pressure. So your goal in this case becomes to build relationship with individuals, and even in this case, sign might just broke. I guess. Answering questions right away.
May we ask questions or to the end?
Oh, shouldn't.
Well, I'm not sure. Yeah, you want to? Yeah, okay. So, I mean, people are champing at the bit. I'm talking too much. We'll start looking to the crowd for some questions.
Okay, sorry, I didn't mean to interrupt. I wanted to ask, if I understand your concept correctly, you're sort of like modeling the income a person might make over their life and sort of investing on them based on that valuation. However, I'm wondering how you see that potentially perpetuating systemic inequities. For instance, women with the same level of education or in the same jobs frequently earn less than men. Statistically, it's just a fact, as well as like people of color. So I'm curious how you think about that. Like, do you see this concept as essentially perpetuating inequities by only providing more capital to people that are already in places of privilege, who will be able to make more money in the future?
Two questions in one, honestly. The first one is whether we see the inequality will grow in there, and the second one is like the existing inequality in pays for different genders. Like, completely two different conversations. We can answer on sort of view on both of them.
This model will for sure
Create
not solve inequality, for sure. But what we experience is that there are groups out there who, without capitalist, otherwise, their success rate will be even lower. So what we see right now is that ability to access capital creates
distortion.
quite a significant inequality already today.
What's interesting about this athletes, again, because this is like already happening. The guy who was top paid, didn't speak English, was 17 years old from poor family of immigrants. For him to even get access to this $1 million, which allowed him not to go quit college and go find a job and blah blah. So it actually propelled him into the situation where he ended up being paid $300 million.
So from this perspective, we do believe that it will decrease the inequality, but it will not solve it completely. And it definitely will, because of the existing inequality, it will definitely kind of continue some of it.
So a lot of psychologists are anyway. Will the kids from the rich families even do that? Like, why would they even sell the share of their future? Or will investors invest in themselves, like doing all this legends on the generations? The first one creates, the second one increase, the third one leaves. Like this, like you always in between trying to like play the psychological game of who is going to agree to this. The question is like, is it adverse selection or is it not adverse selection? It's also at the same level. Why would I do that? And if my parents know that I am going to be like the $1 trillion company in the future, why wouldn't they do that themselves? If they're already rich, why would they give up the profit to the investors outside?
So what we see, like for example, right now, is that a lot of individuals who are in disadvantaged position, when they, for example, go to college, they need to take a loan to get to school, and then in perfect world, that in equity investment should be the same in terms of the outcome in the perfect environment. But psychologically, it works quite differently. And when you have that, you are likely take the risk, which actually will lead to a better outcome. So still, from this perspective, we see that the current system creates much more inequality than the model which we propose. But the truth is that we do believe that first, this should be tested. We do believe that first, we need to see these outcomes. For example, we don't touch teenagers right now, because we believe that we should be careful and cautious in that we need to check this model first with individuals who like understand what is investment, and from this perspective, we don't risk to kind of make an agreement with a person who don't really understand what the consequences of these agreements are. So from this perspective, we do believe that we need to be careful, and we need to make like 100 experiments before we will claim that it's clear it works perfectly in terms of quality.
Inject.
Let's do it more. And we solve for ourselves this challenge through the prisms that we decided, okay, like we'll do with founders, we first will do with ourselves, not only with ourselves, four of us did it, two of our sisters into us, so it was quite gender equal for the very first day. But we decided we first will do it with founders to be sure that it's working, and only then kind of push it as a narrative for the entire world to accept. But we agree that inequality is there, and we agree that this model will definitely not solve all.
I'm really complicated to digest rejection.
Should everyone do this? And we're like, obviously we're not there yet, but should everyone in the United States do this from the young age? Like basically raising capital stage by stage, progressing towards those who just basically going to be employed, and those who will build companies and make how's it called? Outstanding outcome. Get up. We don't take the averages. That's where you actually build the model anyway. And if we take the average, the average income in the United States, what is it, $60-something thousand, whatever. Let's make it 50 to make it easier, and that multiplied in 30 years, it's $1.5 million. If we then take, let's say, what is going to be half of the people in the United States works, let's assume. 25% is school, 25% is pension, and in between half of the population should work. Otherwise, how will they survive? So let's say it's half of the population which is making $1.5 million over the course of their work years. In total, it's something like $200-something trillion of potential wealth. The entire economy is not there yet. It's like, imagine that currently all of the publicly traded companies is something around $30 trillion cumulatively, like their total valuation. The total market is probably around, I don't know, like you guys know better, something like $80 trillion probably, somewhere there. And the total amount of your future worth, like people's future worth, is $250, let's say, trillion. If we look at this perspective, then the inequality in wealth dramatically changes. The money outflow from the bonds and the corporate stocks towards the bonds and individual stock.
From this perspective, income inequality is way lower. It's still there, but it's way lower than wealth inequality. So if we create wealth from the income and we kind of convert income to wealth, we at least will get to the point where right now income inequality is, which will be already way better than what we experience with the wealth right now.
Hi, Chris. Hey, Chris. So obviously, if you are a board member of a corporation, you have kind of a say in the decisions that company makes. So if you're investing in an individual, how much autonomy does that individual get to retain in terms of their decisions, especially if a lot of, I guess, personal life choices can also have impact in terms of their evolved income capabilities?
It is yet to be defined by the market of what is expected. In our personal case, we said there's no say from the investors, but there is like an insane level of transparency. We show them all of our bank accounts, and we provide them with our tax forms, tax reports every year.
Yeah, from this perspective, the way we model it is that there is no say for investors in what you will decide. What helps us that statistics in the venture market showed that actually startups where founders had these golden shares, where they actually have full control, outperform on average startups where it's not. So actually, the statistics helped to change the perspective, because before that, the main belief was that investors should have this control.
Adults in the room need to control the kids who have
Yes. And it's true that in the companies where founders don't have these golden shares, that dispersion of results are much smaller. But the average result is much higher for the companies where founders 100% control the decision making in the companies.
Another perspective from the same is that you actually really want to aim for the most successful ones, and you write off those who failed. And then from this perspective, you don't care about like whether they made another $1,000 and don't report to you, but you will see that someone has actually become a billionaire. Like it is not going to be invisible to you from this perspective. So, and then the investors basically invest in not in this particular company, but in all of your accounts. That's why what they have to say in terms, I'll tell you what we do as a say with our investees. It's like, so, like, seems like it's not working.
And you will never hear such advice from an investor.
Work! You have to return me my money! And we're like, no, go for a vacation. Stop it. It's not working.
Because we are long-term with this individual. And that's what we also like in terms of how our relationship with investors changed. We previously created multiple companies. Some of them were bootstrapped. Some of them had venture investment. And now we have much better relationship with investors because now you can actually discuss your problems. Before that, no way. Before that, you will always only picture this beautiful projection. But now we actually can have the conversation that, like, this company is failing. Probably we need to close it. So we do believe that in general, even if you don't do this with yourself, it's a good advice to have a board. They will be advisors. You will be still the decision maker. But to have a board of people who care,
and you are financially interested in your own success,
it's actually a good thing for you.
Like this is our own case. We invested in someone who became a good friend of ours over times of years of us investing in the person. And the pressure was so high that eventually the guy lost the shit and end up in a facility for like several years. Like we should have stopped him from doing this, and we would have made more money by just like drop it, like start another one in a year, rather than like just basically spending several years of not doing anything.
Makes sense. Thank you.
Oh, who knows where? How about all the way?
2 years ago, here at Yale, some undergrads, maybe grad students started old Prospinity. I give connection via Sam Lesson. But the premise there was some sort of income shares. You form a pool of friends who want to agree above some threshold, willing to allocate some small percentage of your income to like this big pool and then evenly split amongst friends, and you get the benefit of, or maybe friends, you have no idea who they are. You get the benefit of sort of this community that's like supporting each other, but also not just like a huge influx of capital, but less psychological pressure and so on and so forth. Like, how does that compare to this sort of methodology?
It is one of the approach. We actually also investors in another pool like that accumulator. We actually believe that this type of models should work pretty well. They are more like on the safety net side. The insurance, I would do it. Like if you have an opportunity, it's actually a quite good thing to have. Not only because it's great insurance, it's also, if they implemented it right, it also generates a quite tight community of people who really invested in each other.
We are investors and we are part of have something like 25 unicorn founders, like currently run companies, and over 50 with hundreds of millions of dollars valuation.
So it worked pretty well for all of us in this pool. So actually,
some companies fail, and like they're still there in the community, and people are just like, it could have been us. So we're okay with that.
So actually, we do believe that this type of ideas, they greatly complement what
with the pressure
than what we create. So we don't see this as a competition. In general, you mentioned Sam Lessing is one of the investors.
Sam was the first one. Like, he was the first one who invested in us.
He's actually also a believer in he directly investing in people. He has a separate fund for creators. So he invests in like YouTube creators or like people like that. So he has a model, and he truly believes that those individuals, they right now get some cash flow businesses, but as capital, they actually can accelerate their growth significantly.
And this is the case. So together with one of our investment, even though like our thesis was around startup founders, we invested in one of the YouTubers. And,
Yeah. So it's all complementary because
investing in her, really good case.
so as Daniel mentioned, this opportunity is 250 trillion opportunity. In such a market, there is no competition. There is like you're all like just pushing this rock uphill, but the opportunities is so large, so many different approaches will be implemented, and who will be the final solution, no one knows.
I apologize. I have no idea in which order these hands came up. All the way in the back, blue shirt. Yeah.
Yeah, so I can imagine, as it is right now, it's a relatively small market. You're obviously, good people, good investors, but I can imagine as this market segment starts to grow, you'll start to have unscrupulous investors that have a direct financial, essentially control over me if I'm really accepting investment. In a normal LLC, I can just shut down the company, I can sell my share, but I can't really like sell that share of like myself to someone else. So how do you control against that potential for coercion?
Yes, the only thing which we see is that should be done is that we kind of pushing us forward for like with two things. We really want to introduce a calculator so that anyone can like input their data and see like what approximately should be value so that you won't be screwed. The main thing how you can be screwed if someone will try to buy
Too much?
the chip. And for that, we believe that we need to push forward more information, more data, more examples, and be transparent from this perspective.
But we publicly published our own contracts on our website.
Same, like what YC, Y Combinator did with investments, they published the safe agreement. And originally, I remember like none of the investors wanted to sign, but because they had this power, they pushed this as a standard, and now it's so easy to raise investment because of that. So we do believe that it's really important to push standards. So that then, if someone approached you, and said like, I want to invest in you, you will just point out, like, this is the standard agreement. If you're ready to sign that, I'm ready to go in. So this type of things can be done to mitigate this and just educate people more about their values, that they actually quite their future is quite valuable.
Interestingly, people can force you to work. And if you stop working, they just get zero. So you have the leverage.
It's just, thank you for the question. A lot of the questions were of this variety from the crowd that there's just something about the
Endangered servitude.
Yeah, indentured servitude was a word that got used, even slavery, like really harsh words like that, there's something about selling shares in a person that just feels like fundamentally wrong, and that it's somehow crossing a moral line for people. And there was a lot of concern about whether this is going to bring about some sort of dystopia. My wife loves these sci-fi things, so she started rattling them all off to me. But, this is a genre. Like, people are always owned by somebody in the future. And, I don't know. How do you feel about these concerns?
First of all, there is a really good sci-fi book about that. It's called Unincorporated Man.
Yeah, the unincorporated, that's one of them.
Yes, actually, the interesting is that they try to critique this idea, but they actually are quite balanced. They show like positive side and negative side of this idea. So it's a
negative side on the sort of like screwing the system from the corporate from the corporate perspective?
So we do believe, first of all, we do believe that's a very important difference is that this idea that investors don't have control, so they don't decide what you do.
But then you have there's no control and there's no board. Do you not have like a fiduciary duty to your investors? Like if it was a company I was starting, I sure do, and that's what a board is there to do, to keep me on the
Yes, so
guardrails. But like what does that work here?
Yes, if you created a company and you own the shares in this company through the structure, you will have fiduciary responsibility to kind of act with these shares in a responsible manner. But it will not include. There is nothing in the law which can force you to create a new company or to actually follow some particular ideas. So what we see is that the current balance when it's this corporation is actually investors haven't really transferred money on your personal account. They transfer money on this corporation, and the only additional protection to them is this pledge agreement. So this creates a balance, because if it's about assets of this company, you for sure need to be responsible. So if you already created a startup and you own the shares in the startup,
Yes.
you need to be responsible. But if it's about your future attempts, which are not defined, and we literally saying in the agreement that there is no defined plan, there is no promise to create the company. Like for example, in the music industry, there are a lot of controversy cases. In all these cases, the main controversy was that this agreement stated how many albums this artist should release, and that's where things weren't really pleasant and balanced. In our case, we literally say in the agreement that there is no promise to create, but if something is created, then you're responsible to assign the shares. So we do believe that, as I mentioned, it is an experiment, and so we try to make this experiment with people who already had some sort of experience with investment, so it's not like something completely new for them. So we really want them to understand. We also spend some time explaining what is the agreement so that they will not be shocked in the future what actually this agreement means. Our case here is that if we will be able to create multiple good examples, like with this fund which invested in athletes. You can Google the interview of this athlete who paid them $35 million. That's a really great story because he actually explains that it was life-changing for him. It's actually really helped him to focus on sports and achieved the results which he achieved. And we understand that we need more of stories like that, and also show stories not only of successes, but how we behaved when someone weren't successful and failed, and to actually show that we were much more supportive than the regular investors because of our alignment with these individuals. And through this experience, we hope that we'll be able to form the narrative which is a positive version of this future. But we agree that a lot of irresponsible stuff can be made, but they are possible even without us being involved. Vice versa, we're trying to set standards. We're trying to be transparent with the standards. We published our own agreements. We actually first did it with ourselves. To show, in our community, we know to be the most freedom-seeking people. We definitely don't want anyone to interfere our decision control, and we show that we know in that we actually signed this agreement. So kind of put our own destiny on whether we were right in terms of legal wording of this agreement. But for sure, a lot of bad stuff can be made if it's made irresponsible.
You were teasing before we started. I don't know. I wanted to make sure you get a chance to say it. Some new developments, perhaps, in the investing in people front that haven't been published anywhere, or aren't. And did you want to say anything about them?
Yeah, so one of the recent development is that we also, because we approached many founders, we interviewed more than 160 founders and wanted to learn how they would use these funds. And we originally designed it for them to use it for their next venture so that they will retain a higher share of ownership at the next venture. But we got a lot of responses that they would use these funds to buy a house, like to pay for down payment for mortgage. I'm not sure that
We
everyone
said
knows.
that they can do this, but we highly advise not to, because otherwise they would have to pay a lot of taxes.
And so it originally wasn't designed properly for that, but it's really a strange inefficiency of the market. Like you always want to see these inefficiencies if you want to build some ventures. And one of the inefficiencies that even when you see a super successful founder, like for example, founder of Notion or founder of Perplexity, like it's billion-dollar companies, but none of them can buy a house. And this is it's just an efficiency of current banking system, how it looks at you in terms of your wealth. As I mentioned, like you all like really wealthy people in terms of your future value, but banks want to see some of the standard check marks. So we decided to solve this problem, and we built a product which allows to use your future to buy a house. But we designed it properly so that any additional overhead is happening only when you're really successful. And this is another like approach to the same idea. As Daniel mentioned, if we accumulate all the future wealth of young people, because young people are more productive than previous generation, their wealth is actually should be higher, not lower as it's today. But today, system is built to prefer equity rather than income. For example, capital gain tax is lower than your income tax. So even that creates this difference which over time accumulate. But what we want to show is that actually if you will be able to use your future as real capital, in this case, for each of you to buy a house, for each of you to pay for your education, it will be easy thing to do. It will be like, okay, like it will worth like 10% of my future income, okay, but I will have a house for my life and think like that. But now, because you are not equity owner, but vice versa, you're a renter, you pay much more in you kind of in this constant cycle. If you will look at the generations in how the wealth was concentrated previously and how the wealth is concentrated right now, it's actually really not really great picture for you, like as a generation, because all the wealth is through different regulations, through different policies and decisions which were made in the past, they benefit the previous generations rather than yours. And from this perspective, we see that if we can change the narrative, and if your future income will become the wealth, in this case, it appears that every existing means of production or every existing real estate asset can be easily acquired by the young generation and used properly and efficiently for their future benefits to come. If you will think about what type of changes AI can bring in the world, you want the scenario where you all owners of this future AI, because it will create a lot of disruption in the job market, etc. But if you will be the owners, it's totally fine. But it's not what's happening today. Today, this companies, NVIDIA, Microsoft, and the major benefiters of those changes they like 95% owned by pension funds, so they 95% owned by previous generations, instead of you who actually provide most of the productive work. So we definitely look from different perspective of how it can be changed, and the idea to use your future to actually acquire real estate right now is one of the models which we experiment.
More understandable for the LPs, for the investors today, and therefore we're sort of like develop the product. It helped us raise more money. It explained the idea better. From the perspective, it was like, oh, I see there will be an answer behind this now, sort of like a lantern.
And we hope that through this model, like in 5 years from now, it would be crazy to imagine that Series A, Series B founders like, still renting a one-bedroom apartment.
Listen, sorry, I think we are starting losing the audience, so it's the right time to wrap up. And let me ask the last question as it was. So today we have like MBA guys from School of Management, and we have like undergrads from Yale College. What would be your advice for this type of audience? Should I mean the one advice, or would you like divide it into three?
You know, our main advice is to risk. And I know that it's not popular those days. I'm afraid that most of you think about your like job in a consulting firm or things like that, and how it can bring you a good salary or a bank. And I understand that it is safe, and I understand that likely you have some things or debts which can limit you. But right now, at your kind of stage of the journey, your future self will benefit a lot from your taking risk today. And that's what we also want to solve, because our deal which we structured is actually not between you and investors. It's about making a deal with you and successful you. So successful you want you to happen, like want you to be the successful you. And if some capital right now can help you to get there, it's reasonable for a successful you to pay that. Before this tool is available for all of you, unfortunately, the only other way for you to successful you to happen is to risk.
And another one is AI. Yeah, for sure. Like hear it from everywhere.
Pay a lot of attention to that.
Literally, it's not as complicated and as hard to use it today from many perspectives. Changing a lot of the processes in every single area of professional activity.
Yeah, so when we started our career, it was norm to spend like 4 years developing a product before it will be released. Then through different lean approaches and development of APIs, we'll all get to a state when we can release a product in a year. With the modern technologies, you can actually build a substantial product during like over summer. And if you don't use this opportunity, you're losing a lot. Like in terms of your future successful self.
What's really important to understand about AI right now is this is all about instructions. If you are capable of giving a precise instructions of what it needs to do, you will find a way to do the job of what everyone before you was doing for like days. You will do it in minutes or hours. Like, but the trick is currently it's not 100% guaranteed thing. Even if you will have a good request, it's not necessarily will give you the good answer. That's why you have to fail multiple times in trying to overcome the misunderstanding with you and the current AI models to get to the result which you want to achieve.
But it's
like fail 3 times before you're like, this thing doesn't work.
But it's a little bit about the same. So you need to be a little bit more long-term about yourself. So don't think about what is actually needed today. Think a little bit like what will be in 20 years from now, like what industries will change, because you have this opportunity to invest in long term. Like people on later in their career don't have already such opportunity. They don't think they cannot think about themselves in terms of where I should be in 30 years, where the world would be in 30 years. But you can, and you have this great opportunity. And I highly advise each of you to invest more of your weekends thinking about that.
Thank you.
Thank you.